According to supply managers in the 9 Mid-America states, how is the economy performing?
Welcome, I'm Ernie Goss, Professor of Economics here at Creighton University, to talk about our monthly survey, our January survey of supply managers. That's manufacturing supply managers in the 9 Mid-American states. The overall reading was down from 47.1 last month, December, to 47 this month. Obviously, neither of those readings are good. They're both below growth neutral, and it's the lowest January recording that we've had since 2008. So the lowest January recorded reading since 2008. So it was not a good month. We'll have to wait and see what next month comes about. We ask about the threats to the firms, the businesses, the economy, what they judged as the top, and supply chain disruptions were number one, higher input prices number two, and recession number three. So what was surprising is finding and hiring qualified workers. Labor shortages was not in the top six, so that was a surprise to me. We had the average wage growth that we're seeing now, unadjusted for inflation, was 4.1% for the region. Now, when you adjust for inflation, it's minus 2.2%. So that was a surprise. That's not good, of course. Here I'll bring up the graph charting the overall Creighton number, and that's the 9 Mid-America states, against the U.S. number, which will come out later on this morning. And you see there it's declined for 3 straight months. The U.S. number will come out. It's going to be much like ours. I expect it to be down as well. But to say it's below growth neutral, but say it's predicting a recession would be too strong. It's definitely slower growth, slow to no to negative growth in the weeks and months ahead.
What were the hiring trends?
Hiring in the region, the 9-state region, was not good for the month of January. The number for the hiring was 46.3, and that's down from December's 54.2, which is obviously above growth neutral. The January reading is much like the November reading, around 45 to 46, but 46.3, that's weak. Almost 26% reported workforce reductions. So instead of gaining, we're reducing the size of the workforce in the region. The overall region, when we look at compared to pre-COVID levels, we're almost even. In other words, we're down about 6,800 workers in the entire 9-state region from pre-COVID. That'd be February of 2020. So still down from pre-COVID numbers. When you look at the U.S. number, it's up about 0.8% from pre-COVID levels, and that's some 1.3 million workers gain for the U.S., but again, for the region, down about 7,000 workers. Year over year, though, we're talking about tracking 3.3% growth. So we're still tracking growth there, but the reading for the month of January was not growth, it was downturn. The four states have employment numbers that's seasonally adjusted, non-farm employment numbers above pre-COVID levels. That would be Arkansas, Missouri, Nebraska, and South Dakota.
What inflation trends are you noticing?
Our inflation reading for the month was not good. The price index, our price gauge, was at 74.2. Now, this is a wholesale price index, which is elevated significantly from December's reading of 52.1. When we asked the supply managers about the price they're going to be paying for inputs, it was only up 2.9%, or about almost 3% for 2023. That's the good news, but again, the bad news is the elevated numbers for the month of January. When you're looking at the CPI for the entire year, that's the Consumer Price Index, year over year, we're at 6.5%. Now the core, which subtracts out food and energy, is at 5.7. Both those numbers are about triple the Federal Reserve's expected or target rate, which is 2%. Now the Fed meets later on today, and I expect a 0.25% increase because of this elevated inflationary pressures.
What is the economic outlook?
The outlook is slow to no to negative growth, and I expect it to be almost about zero. In other words, flatlining for the next quarter and probably the second quarter as well. I think from January to February, we're going to see 4% growth in inflationary pressures, 4% increase in the CPI. I think that'll be what's reported by the Federal Reserve and the Bureau of Labor Statistics, I should say. Economic growth will likely dip into negative territory, but only slightly. This is going to be what the Federal Reserve is shooting for, which I think is a soft landing, which will be job losses. We'll see job losses and the unemployment rate rising ever so slightly. The unemployment rate rising, employment growth moving into negative territory. But it'll be a blip there, I think, for the first quarter and the second quarter. We're talking about supply chain disruptions will likely move sideways. We're still seeing issues with transportation, getting those goods off the docks and getting those inputs into the companies. So that's going to be an issue. Short-term interest rates will rise by another 0.5% by the end of the first quarter of 2023. That's a 0.5% increase in the prime rate. Short-term rates will rise by another 0.5%. Long-term rates will likely move sideways. Not much of an increase. They may well increase a bit, but I don't expect long-term rates to move up much. Prime rate will rise from current 7.5% to about 8% by the end of the first quarter of 2023. Keep an eye on the bond market. That'll tell you about where everything is moving. Now, particularly keep an eye on the 10-year Treasury. That rate has come down by 25 basis points over the last month, indicating that long-term investors expect inflation to be conquered by the Federal Reserve, and I think the Federal Reserve will conquer inflation, meaning moving it back down to 2%. It's going to take a while though, but the inflation number long-term will move back down to 2%. It will probably not be in this year though. The national ISM reading, which comes out later on this morning for January, like ours, it'll be below growth neutral, probably in the range of 47 to 48. We're talking about price of a barrel of oil. I think it will continue to move sideways to up because of the federal government's purchases for the strategic reserves, increasing that. We're likely to see oil prices move up a bit. Also, gasoline prices, I expect those to move up because of refinery maintenance, so watch out for higher gasoline and fuel prices. Now, I don't think it won't be like what we saw earlier in 2022, but it's still going to be up for 2023. And finally, listen to what the members of the Federal Open Market Committee talk about. They'll be talking. That'll be Jay Powell, head of the Federal Reserve, will be talking later on today. Listen to what they say in the weeks and months ahead, because that is going to tell you where interest rates are going, where inflation is going, and a lot to do with where the overall economy is going. That's it for the month of January, and it was not a good reading, not a good month. Inflation was up, growth was down, but we'll have to wait and see what comes about for the first business day in March. Until then, may your economic cup runneth over, and thank you for joining in.